Welcome to our weekly live stream recording of the M&A Zing, a podcast series devoted to acquisition entrepreneurs, search funds and holdco builders in the UK and EU, discussing the topics and challenges that impact SMB succession M&A and exploring the highs and lows of searching, acquiring, owning and operating small and medium-sized businesses. I'm joined as ever by my illustrious co-host, Gareth Hawkins, CEO of BizCrunch, serial acquirer and font of all M&A knowledge. How are you this week, Gareth?
Oh, I'm all right. Thanks, Alfie. How are you?
I'm good, thank you. Yeah, enjoying the nice weather.
Isn't it great? Yeah, I love this time of year. Really makes you feel like everything's possible. It reminds me that what needs to be possible is us to have a new intro.
I'll write a new one.
Yeah. Okay, buddy. Cool. Well, let's get stuck in. We want to make this a quick fire, right?
Yes. So why don't you start off with the news and then we'll get into our topic.
Will do. So I had the privilege and pleasure of being at the Business Leader Summit yesterday in Westminster, which since Richard Harpin acquired the Business Leader kind of community and publication a couple of years ago, he's really kind of super scaled it and supercharged it. It's awesome. And this summit yesterday was filled with great minds. There was, several hundred business leaders in the room, as well as a number of illustrious speakers from places like Goldman Sachs and the CBI. So the morning opened with Rupert Soames, the chair of the Confederation of British Industry, having a very frank kind of fireside, if you will, in a panel at the launch, in which, in addition to declaring on behalf of the sentiment of all British businesses that we're all very pissed off and irritated with the Labour government, which I thought was nice and candid, he declared that the biggest opportunity right now is retirement age-owned businesses, which was delightful to hear him say, because it's a great acknowledgement, really, from someone who is very senior in the business landscape for Britain, acknowledging the problem.
Yeah, that's fantastic. It's really nice to see people sort of waking up to this. We've been banging on this drum for a little while now. So it's nice to see everyone else sort of coming on board.
Well, my hope is that comments from people like Rupert will have the Department for Business, wake up and smell the coffee and realise that something needs to be done. I think whilst the Innovate UK and the British Business Bank are all kind of dancing to a new tune, and certainly Stephen Welton and Lewis at the British Business Bank are very keen to ensure that they are funding growth. This is where growth can come through continuity of businesses. So I really hope that this gets on to Jonathan Reynolds' radar properly, and that something is done about earmarking some funds specifically for succession M&A, because we have to solve this problem as a nation. So
I wholeheartedly agree.
Great.
Exciting
what
stuff.
Else?
So I have some very exciting news. A new talent sourcing platform for searchers has gone live, SearchFundCareers.com. So it's initially seems to be US focused. I had a look on there. Some of the jobs look super exciting. It's mainly sort of MBA internships with search funds. It's hot on the heels of Smith List, who developed a great following among lots of sort of ambitious, great operators.
We love Will Smith.
We do. But yes, really exciting. Lots of really cool jobs on there. Some great sort of avenues in for those finishing their MBAs and getting into search funds and acquiring businesses. So it's really cool. And yet another kind of milestone, I think, that shows how far we're progressing. The fact that this didn't exist before and now it has is a kind of testament to how this search fund and acquisition entrepreneurship is growing.
It's coming of age, yeah, and actually it's becoming a destination, beyond those that are graduating and looking to buy businesses to operate. Those that want to go out and work for and cut their teeth in acquired companies, that's fantastic. And to think that there are now these kind of forums, these communities in which people with that inclination can find work, brilliant. God knows most of the searchers want to surround themselves with more talent, more ambitious talent. Internships is one way of doing that cost effectively. Yeah,
absolutely. Any more news, Gareth?
I guess one final piece of news from me, and that's really for our listeners down under, that there is a growing, like we have here in Europe, there is a growing ETA ecosystem, if you will, in Oz. And ETA Central is at the center of that, very aptly named. And they have a couple of events coming up. They firstly have a meetup in Brisbane from about 4 p.m. next Wednesday, the 2nd of April, at the Stock Exchange Hotel in Brisbane. And then shortly after that, 1 week later, they have a 2-day ETA forum taking place in Queenstown on the 10th and 11th of April. And it looks to be some pretty awesome speakers actually on the roster for that. If it wasn't the best part of a day's flying away, I would be there in a heartbeat. But yeah, as this continues to grow, I definitely need to get down under and check out this scene.
It's something that I hear about quite a lot, that the scene in Australia. I've spoken to a few of our customers about that, and I know that people have come up and spoke to you about it, some of the things that you've spoken about before. So some exciting opportunities down there. Most
definitely, yeah. Suffers from the same baby boomer generation of retirement business age owner challenge that a lot of the developed world does. So yeah, good. Well, so we've got 25 minutes to get stuck into our key topic today, Alfie, which is...
Okay. We're going to do a quick fire today. Let's talk legals.
Nice.
So Gareth and I are going to go back and forth with 5 points each for some of the most important legal documents that you will need in your acquisition process.
And blimey, there's a lot of them, aren't there? I mean, when you really sit there and lay them all out, there's quite a smorgasbord of legal docs that you may need, depending on the structure of the transaction that you're pursuing. You probably won't need all of them, but to be able to pick from a salad cart of different different documents to suit your need.
We've certainly picked a tough topic to do quickfire on, because we could do a couple of hours on this, I'm sure.
Well, to continue the food analogy, let's call this an appetizer, because we have a queue of very competent, experienced M&A lawyers that are quite keen to come onto this podcast and give the listeners a break from just listening to me all the time. Let's get started with this, but know that we're going to get some more competent professionals to come and elaborate over the coming weeks.
Fantastic. Maybe we can base some of the topics on questions that we get and things that people find most interesting. Okay,
so folks, put them in the comments.
Yes, please do. So we're going to go through these in chronological order, how they should pop up in your acquisition journey. So I'm going to start us off with LOIs, letters of intent. So here's my top 5 points to think about. Binding and non-binding terms. So it's crucial to understand which parts of your LOI are binding and which ones aren't. So usually
very little of it is.
Well, yes, generally, and most people kind of think of them as a gentleman's agreement, but there are some provisions like confidentiality or exclusivity which are legally enforceable. So a lot of people make that mistake and then don't realize that, if you break some of these clauses, you can face real consequences. So be absolutely clear from the start what's indicative and what's locked in. Point 2, purchase price and structure. So does the LOI state a fixed amount, or is it open to adjustments? Maybe there's an earn out where the seller gets more if the business hits certain targets. You also want to clarify whether you're buying the shares outright or purchasing assets only. Again, some of these things can sort of come out in the wash, as we would say, but it's good to kind of set your stall out early on, especially if you do have a specific structure in mind that may be slightly out of the ordinary. If you're dealing with a seller that hasn't come across some of these things before, it's a good idea to set your stall out at the start and hopefully fewer road bumps down the line. Which leads me on to point 3, due diligence. So we talked a lot about this last week. And one of the things that we touched on is how having a prepared seller can make a real difference. And this is your chance to set them off in the right direction. So your LOI could and should contain an outline of, what kind of investigations you'll be conducting, financial, legal, operational, and how deep you can go. It's your chance to make sure that you have access to the records you need further down the line. It's better to kind of iron out these expectations now than have those awkward surprises later down the line. Number 4 is the exclusivity period. So typically you'll see a clause that says the seller can't negotiate with other potential buyers for a certain number of days. And this can be a game changer. If you're investing time and resources into this whole process, you don't want to risk another buyer swooping in and taking this off your plate, as it were. But you have to get the right balance of making sure the exclusivity window isn't too short for you to get your checks done, or so long that they feel locked up indefinitely. If you set
completely agree.
Sorry,
it's a must. You must have an exclusivity period in there. You don't want to be into a gazumping situation.
No, absolutely. But as a seller, they don't want you to come along and say, "Hey, it's a year" or something like that, because that's going to obviously put them off. And you need to strike that balance. Absolutely. And
it's also a nice way of setting an expectation on time frame for getting the deal done, by the way.
Yeah, that's another great point. Actually, I hadn't thought of it that way. Yes, I suppose early on you're kind of, setting them up for how long this might take and preparing them in their minds. I think some people go into this expecting it to be a much quicker process than it is. So again, I think the kind of common theme of this LOI is setting the boundaries, kind of letting the seller know what you're going to want from them and how long this might take.
Yeah.
Which leads us nicely onto break fees and termination rights. So some LOIs include a penalty if one party walks away without good reason. On the flip side, you want to specify under what circumstances it's acceptable to exit the deal. So, if a major red flag comes up in due diligence, for example, having that break clause and the termination rights set out at the start keeps everyone motivated to proceed fairly.
Yeah, I mean, I've tended to put a nominal kind of 10K in mine just to kind of cover preliminary legals, and it tends to run one way in my LOIs. Yeah. But, there are no rules.
No, absolutely. And yeah, look, the common theme across all of those things is letting the seller know what you expect from them, what they can expect from you. It's kind of setting the rules of the game, I think, for what comes next. Which is
the heads of terms. Yep. So once you have an offer accepted, if you like, your letter of intent is really formalization of your offer. And some folks actually attach a kind of signature piece to that, which is like an acknowledgement of an acceptance of, like you say, non-binding. But as you move from that into preparing your share purchase agreement, you want to summarize almost like your shopping list, your checklist of things that are going to go into that SPA in a very kind of like high level, because this becomes the recipe that goes to the lawyers for them to make sure that they're capturing all those points and putting them into the long form clauses in the SPA. But what should they look like? Well, of course, the key commercial terms are front and center. So, what's the price? How are we reaching that value? How much of that is upfront and how much of that is deferred over what period? So you've got those kind of terms that need to go in there. Are there any conditionalities around the earnout, for example? So if you've got X% contingent on performance, you may want to be making a mention at least around that, without necessarily at this stage setting huge targets. They can come out, or the clear targets, they can come out at the SPA. Actually, you might want to sort of nod to them here in the heads of terms. Okay. So what with those conditionalities, what are the sort of triggers in order to achieve, say, for example, an earnout or growth equity conversion? What are the closing plans? What are the closing conditions? Are we using a lockbox for simplicity in terms of like taking a valuation on a day, and therefore there's no kind of post-completion fluctuation there? Or are we doing completion accounts and getting a third party to come and verify? To that end, what's happening with any surplus working capital in the business? So if you're doing a debt-free, cash-free, then anything that's left after the debt is netted off. There is an element of right to that for the seller, but obviously they've got to leave X amount in for some element of working capital in most transactions. So you could define that here. Speaking to warranties and covenants, those are obviously key parts of any SPA. You would talk in outline to those here in the heads of terms around the scope of the warranties, any indemnities, any risks that have been identified or that expect to be identified in due diligence. Things like restrictions, so non-compete, non-solicitations, non-circumventions, these kind of things that will limit future business activities of the seller, but for good cause, because you don't want them going out and chopping you off at the knees. And then I guess the sort of final piece there is dispute resolution. How are you resolving a dispute post SPA? So is that going to be done by arbitration, adjudication? What kind of expert might you appoint to be able to resolve a certain question, particularly with a completion account scenario? So yeah, those are maybe the key things that are, the precursor, if you like, to the share purchase agreement, which I'll come on to talk to in a little while. But parallel to that, given that you're going to be owning the business and going forward, perhaps this is an opportunity to change.
The shareholders
agreement.
You set me up for that and I completely missed it.
That's fine.
So yes, shareholders agreement. This is something that you'll be familiar with if you've been involved in business, even outside of acquisition. It's fairly standard piece of documentation. So we're going to look first at voting rights and decision making. So it's really important to begin to understand the governance structure and approval thresholds for key business decisions, you know, investor consents, vetoes, that kind of thing. If you've ever been involved in a board meeting, you know how this kind of stuff goes. And again, we are setting I don't want to say the boundaries again, but, you know, we're setting the pace for what comes later, what goes into the SPA. We're starting to kind of feel out how things will look post-acquisition. Transfer restrictions are also very important. So we need to check for preemption rights, rights of first refusal, drag along, tag along provisions, that kind of thing. It's important to kind of set your marks on that early on. We don't want any nasty surprises with that down the line. Point 3 is the dividend policy. So something that people are very keen to be clear on our, you know, clarity on profit distribution, you know, whether minority shareholders are protected, you know, what happens at the end of the year when you have some profit left after all this is said and done. The next point is exit strategy. So we're looking for provisions governing future sales, IPOs, buyouts, you know, all this kind of stuff. Again, we're going into this, most acquirers, with an eye on an exit at the end. So
absolutely, it's where my eyes are drawn. I mean, to be honest, when I'm given a shareholders agreement, it's okay, how much are my hands tied, and how geared towards an exit is this?
Yeah, absolutely. And I think that this is, especially if you're going into this with any investors as well, I think this is something that they'll particularly have a keen eye on. You know, it's one eye on the end, even from the start, which I think is smart. You know, this whole thing is a kind of methodical process. I think these kind of first 3 points that we're going through, these first 3 documents, are kind of building us up to the SPA. And that's a smart way of thinking about it. But I think you're always...
This lives in parallel, in tandem with, so the SPA ultimately is your point of, you know, the transaction, and the SHA governs what happens after the transaction. You know, we're all, those that are still on the cap table, we're bound by these rules now. This is how we must interact.
Absolutely. Okay, and final point on the shareholders agreement is deadlock resolution. So it's important to review your mechanisms for resolving disputes among shareholders, you know, mediations, forced buyouts. These are things that hopefully will not happen, but fail to prepare to fail, as they say. So it's great to have those provisions put in at this stage.
Yeah, I mean, you often see the chair getting the casting vote, right? If there's a deadlock, if there isn't a consensus, or if there isn't a majority, then, you know, chairs rules. You sometimes see a scenario though where certainly experienced founders and owners have given themselves that kind of golden share to resolve deadlocks, which isn't a terrible idea, but it depends on your own appetite for whether you want, and also whether the seller is staying around. If they are, you probably want to revoke that golden share and move it more in your favor, given that you hopefully will be the majority owner by this point.
Yeah, I can certainly see a slip up there if that if that wasn't taken care of.
Oh, it's you know, shares, share classes, voting rights, they are alchemical, and actually, you know, to the victor the spoils there, frankly. So sorry, go ahead.
No, I was going to say, you know, that sounds like it'd be a great topic for if we were going to do a deeper dive on any one of these topics. I think if you're saying it's alchemical and so important, perhaps that's something we could delve into if we bring on one of those very
experts.
Clued up M&A lawyer experts that you were talking about earlier.
Yeah, it'd be lovely to have them speak from experience around particular esoteric deal structures, you know, where you are doing things with, you know, sophisticated call options and certain changes of share class. We might come on to that in a little while with articles and call options. But before that, we need to get into the meat and bones of the SPA. So the share purchase agreement is the kind of key objective and culmination of this acquisition, right? This is defining the price mechanisms and any adjustments to that price. It's talking about whether the price is fixed or whether there are any post-close adjustments. This talks in detail about the structure of any earnout, and we'll go into sort of formulaic measures of how the earnout would qualify. Here we go into great detail about the warranties and the covenants and the representations. We're scrutinizing the statement. So at this point, the sellers are actually warranting. They are making legally binding assertions of what they know to be true about the company. And that is where they remain on the hook. So, there's an effective breach of contract if they are, attesting to something that they know to be false or improper or irregular. So here, you are really getting assurances from them with legal consequences and financial consequences for them in the event that, it's turned out to be a lie. So you want to make sure that your warranties and your covenants are watertight. Indemnities as well. So there normally is a kind of aggregate materiality threshold of, in the event that post-deal we find these liabilities have an aggregate value of, and by which it's like lost business or warranty claims on product or things that might end up with a net burden on the buyer. If they reach a certain aggregate materiality value, you could probably, under certain conditions, go back to the seller and claw back. Now, if you've got deferred consideration, you're clawing back from the deferred. If you've got earnout, you're clawing back from the earnout. So these indemnities and liabilities, that's ultimately what the deferred consideration is there for, a pot of money to make sure everything is okay. And if it isn't okay, I'm taking from that rather than having to prop the business up with new capital coming in. Make sense?
Yeah, it makes total sense, and I totally see why it's important to outline this at this stage.
Yeah, exactly. And this is why SPAs go to significant depth. Just going through one at the moment that's run to I think 80 pages so far before the schedules and the annexes. So yeah, not for the faint-hearted. So then we're into completion and post-completion obligations. So what are the steps for handover from the seller to the buyer? What's going to happen with working capital adjustments? So this is where you've kind of taken what you put in the heads of terms around expected working capital to remain in the business, and you're formulaically calculating how that's achieved. So we're looking at what the regular kind of quarterly working capital requirements are of the business and adding, some sort of variable or contingency to that. What are the seller's obligations post-close? So how long have they got to stay around for? What kind of customers have they got to walk you through? What kind of documents have they got to offer up? You even include things like the keys to the building in here. Right? And these are all the things that must be forthcoming. We talked about domains being in personal ownership and IP being all these things that need to be offered up and provided on completion. So yeah, it's a thorough document.
80 pages is quite a beast. Have you seen any larger than that?
I have. Yep.
I mean, I can see why it would run up to that amount. And this is absolutely the point at which, we were talking about some people try to DIY this process. I can't see that you could adequately get through those 80 pages without the help of some legal representation.
Well, I think that the opinion differs on that one.
Okay.
There's a camp of those that feel that low quantum, small value deals don't need the complexity of an 80-page SPA, and that it can be achieved with, if you like, warranting that everything in the data room was valid, and that is effectively appended to the regular statements around the kind of the deal structure, the warrants and obligations. You can actually produce a distilled version of this in a small number of pages with schedules annexed. But you probably wouldn't go for that kind of expedited approach for high value, high complexity transactions. But if it's all cash up front and the business is doing $500,000 and you're paying 3x and it's here's 1.5 million and these are the obligations on both sides, you could do that in sub 10 pages.
Interesting. Okay, I think that leads us on to our next topic, which is Articles of Association. So Articles of Association kind of outline the fundamental rule book for how our company operates. And the 5 key points to look for here, first of all, it's share classes and rights. So it's important to check if there are different classes of shares, like a class A or a class B, and what rights they may carry. So, does one class have extra voting power? Does it have priority on dividends? You need to make sure each class is clearly defined so you know who controls what. Next up is director appointment and removal. So obviously incredibly important. Look at how directors get appointed, how they get removed. Is there a specific voting majority needed? Are there clauses, letting certain shareholders appoint a director directly. It's a bit of a tongue twister. Understanding these rules will help you manage sort of leadership transitions smoothly. Super important for managing your team, your directors, your board. Very important to get this clear early on. Share transfer rules. So we did touch on this earlier.
But it's normally an equal and opposite. So it appears in the shareholders agreement, but it also needs to have some correlation with an equal clause sat in the Articles of Association. So this is not unusual to see it sort of duplicated here.
Yes, it's just perhaps in a bit more depth in the Articles of Association.
Yeah, more about the mechanics.
Yes. Share transfer rules. So confirm any restrictions on selling shares. So, again, as we mentioned before, preemption rights that require existing shareholders to get first refusal. Check if you need the company's permission to transfer shares. This is particularly important when, if someone decides to sell, you don't want any surprises at this point in time. You need to be super clear.
You don't want any unknown quantities on your cap table, right? So often this is tying the hands to say, look, we are a small group of owners of this company. If you want to sell, you sell to us first. You don't sell to anonymous third party. And if you are going to sell to a third party, the board has to approve it. The majority of shareholders have to approve it, and they have to comply with, X, Y, Z. So this is perfectly normal and good practice. And it surprises me actually that model articles kind of is very mute on a lot of this. Model articles being what you get in the UK when you just incorporate a company, riddled with holes.
Really, that's super interesting. Because I would have thought this would be, fairly standard stuff. It's super important. Okay, well, that does lead us nicely on to my point 4, which is decision-making processes. So you need to know what voting thresholds are required for major decisions. This is really important. So, selling substantial assets, changing the business model. If certain resolutions need a supermajority, you'll want to know that before you try and pass them, obviously. Decision-making processes, and as they pertain to all these other things that we've gone through, share transfer rules and classes and rights and so on, incredibly important to get right in your Articles of Association.
Yeah. And inheriting a lot from the Companies Act. So there are certain special resolutions where you're doing really key things to the business that would require a 75% threshold to pass. But you can actually change elements of that, and you can create additional types of condition that need a certain voting threshold in order to pass when you list them out in your articles like this. So this is where the rule book piece really comes into its own. It's like, what can I do as a board without asking the directors, without asking the shareholders? You could get quite granular here if you chose to.
And going back to the point about the SPA, with these kind of smaller quantum deals and for these mid-market businesses, perhaps not as much detail. I'm guessing the kind of larger the company is, the more in depth we need to go with this stuff.
Yeah, but also remember, if you're taking in external capital, so say you're a traditional search fund, and you've got to represent the rights and respect the interests of your investors, they may want you to consult them or require their vote on certain matters. So some of those things may be inserted here.
Sure. Okay. Yeah. Good point. Okay. And point 5, amendment procedures. So check how changes to the articles themselves can be made. Do you need a unanimous consent or just a special resolution? Again, that's 75% approval. The more you understand the amendment process, the easier it is to adapt the company's rules if needed. So again,
but a little knowledge can be dangerous.
Yes, and look, sometimes changing the rules is not going to be possible. Like you said, if you are beholden to an investor, and this stuff is kind of cast and set in stone. But if there are to be rule changes, there needs to be rules about how you change the rules.
Well, because the articles is such a powerful instrument that if it is bent to the will of a particular party, it can grossly disadvantage others. So what you don't want is people to be bandying around changes to the Articles of Association willy-nilly, because it can actually be quite pointed and quite to the detriment. So you need to, as a investor or as a shareholder, you need to make sure that is cast iron and can't actually just be undermined on a whim.
Okay. Yeah, I can totally see how in the wrong hands it can be a very powerful tool.
Well, there's prejudices that go on within businesses where some folks think they're clever and do things to the detriment and lock out certain investors, or you get factions forming. You don't I err on the side of simplicity, but you need to make sure that you're bulletproof in so much as, it's not a low threshold for things like this to pass. You need absolute consensus amongst, multiple parties. So yeah, it's as I say, it could be quite esoteric. You can get very deep into the detail with an articles association, and you can use it almost as a pointed weapon should you choose. But I'd like to think we've all got better things to do with our time.
Hopefully.
So let's talk about call options, because I've been talking about esoteric deal structures, and one of those is to come in for a very much a minority position in a company that you may want to acquire in the future. And there's a process called a work-in buy-out arrangement, a WIBO, which is sort of popular amongst some of the acquisition entrepreneur communities, like Jeremy Harbour's club. And the WIBO gives you often a sort of a minority interest in the company in return for the services that you have delivered it, so services for equity. But at that point, some savvy acquirers are using call options to say, look, at a particular point in the future that we are going to reach together, I'm going to help you to grow your business to a certain threshold, at which point we can trigger a sale. That call option is a sort of a predetermined outcome whereby that individual that's coming in to help and grow the business can become the acquirer at a moment in time that that has met the seller's requirements, I guess, because they wouldn't sign a call option if they didn't agree that that was achievable or interesting. But so the call option is like a future option contract, but with an option on the buyer to buy. So it's not an obligation, and it basically means that they can say no if things haven't gone their way, but you can have them trigger at a certain point based on conditions. So like, what is the triggering event? Like, is it going to be like on achieving a certain revenue or profitability, or is it a time-based trigger, or is it on the retirement of an individual, or possibly the death of an individual? Those kind of things can be baked in, if you like, to a call option. Valuation mechanism: how are you going to value the business when the call option is triggered? Is it going to be a simple multiple of EBITDA? Are you going to have a third-party qualified accountant actually calculate what your net profit before tax is, for example, and say, right, that's the formula we're going to take? So that needs to go in. The exercise period is quite key. So across how many years could I pull this trigger, and what happens if I don't? Like, do they just revert? Does it just expire? Often that's the norm. We sometimes talk about payment terms in here. So, at the point it's exercised, how many days do I have to deliver you the consideration in order for the contract to have been completed and those shares to actually have been purchased? You can end up doing that sometimes without a share purchase agreement. Call option can have a lien over the equity in a company without requiring an SPA. So this is sometimes a way. I mean, it's always a good idea to have an SPA that is sat in waiting to be executed. Sure. But a call option is effectively a contract to sell if the option holder chooses to exercise it. And then, in this situation, what might the transfer restrictions be on the call option itself? So the call option actually has a financial value, realistically. And, imagine in the public markets, we're trading options on commodities or on shares all the time.
Sure.
So same is true in the private market. Like, am I, as an option holder, able to sell that option to, say, for example, a mid-market private equity company? Could I ostensibly go out to lots of little companies, get them all under call options, put that into a holdco, if you will, where I'm owning 10% of 10 companies, but my call option gives me 100% rights if I choose to exercise it, and sell that as a ready-to-execute package to a lower mid-market private equity buyer?
It's interesting.
Yeah, it's
have you seen that done?
Roll-up. Yeah,
have you ever seen that done?
I've seen it done. I've seen it done. I know a number of acquirers that are down the road with that at the moment. Very savvy chaps and chapesses who are ready to execute a virtual roll-up once they hit a certain threshold. So yeah, it's a useful tool, but again, one of these esoteric scenarios. And the same could be said of share buyback situations. So it's important to bear in mind that when a company buys back its shares, it's using capital that the company has an entitlement to or access to, that if the shares are cancelled post buyback, it's an artificial and alternative way of increasing the percentage ownership of the remaining shareholders. So say I only own 10% and the company buys back the 90% from everybody else. Those get cancelled. My 10% suddenly becomes 100%, right? So it's often used, or occasionally used, but when it is used, it's often to use the company's funds to buy the seller out.
Yes, generally done if a company's got sort of sufficient cash and distributable reserves and looking to consolidate ownership.
Alfie, that's a really great point, because it can only be done if they've got sufficient distributable profits. That is normally the trigger. Like if they've got on the balance sheet, $500,000 of distributable profits that it's been accrued over time, and the consideration on the kind of upfront is $500,000. Brilliant. You could use those distributable profits to buy out the seller. So really good point.
Interesting. Okay, so top 5 points on share buyback contracts is something that I've been looking into recently, and I didn't know much about before. I really appreciate that rundown from you there. So number 1 is regulatory compliance. So you need to make sure that your buyback meets all legal requirements. That usually includes shareholder approval, sometimes via special resolution, and adheres to the company's articles of association, any relevant shareholders agreements, everything that we touched on earlier. This again, we start to see how the documents that we even begin this process with start to feed into every step of the journey that we've touched on since.
There's method in the madness.
There is method in the madness. As we just spoke about, so funding and solvency considerations. So you need to check the company has distributable reserves to finance the buyback. If it empties the coffers, you do risk insolvency issues. So ensure there's a healthy financial barrier left post-transaction.
Well, that's also, that would get you struck off as a director if you put your company in that situation. So
right, yeah, exactly. Don't spend every single penny you have on share buybacks and then not have any working capital.
Yeah, that would be a breach of the Companies Act, most definitely.
Yeah. Pricing and payment terms. So how are you setting that share price? Is it a fixed formula, valuation at the time of buyback? You need to clarify who calculates that and how the payment is scheduled. Lump sum, installments, etc. Could help you negate this issue of leaving the coffers empty post buyback. But a really important point there is, how is that share price calculated? Is there a fixed formula? Like you said, is it just a multiple of EBITDA, or are you having, an independent valuation? Important to set that in stone way before this happens.
Yep, agreed. And also, is that buyback all up front, or is there some deferred consideration? Because you can have that situation as well. Like, going to the point about that available distributable profits. Well, that doesn't have to cover the entire value of the transaction. It can cover the upfront, and then the company can pay out of its profits in subsequent years for the balance.
Absolutely. And something you touched on in your kind of a rundown at the start of this is the impact on the shareholding structure. So removing shares from circulation can shift voting power among remaining shareholders. If one holder is selling at a large chunk, you might see a noticeable reshuffle in control and decision-making dynamics. If your shares are tied to voting rights, then company buying back all the shares is going to have an impact on the voting, the board, and how things are done.
It's normally a moment at which you then revisit the shareholders agreement and update and renew, and sometimes in association with the articles, you might issue different share classes at that point. So actually just going through one at the moment where we're having to look at all of those documents.
So this is a question from me to you, because I've not been through this particular process before. If would you need the votes from your shareholders to allow you to, bring a share buyback contract to fruition? And would you have some issues with that because they would maybe lose voting power in the process of you buying back the shares?
Well, I mean, they're all getting, assuming they're all in the same class of share, they're all getting the right to sell. Okay?
Sure.
So
yeah.
But yes, turkeys need to vote for Christmas, right? There needs to be a resolution passed to approve it, to use the funds from the company in order to buy out the shareholders. And some folks don't want to step off yet. So you may have some that don't take up that option and remain on the cap table. I imagine your drag along would probably apply here as well. So if the company is buying out, 75% of its investors or shareholders rather, then everybody else would be obliged. But normally these are kind of minority situations where the company's majority shareholders are saying, we want these guys to go. So we're going to do a buyback from the company's distributable profits and pay these ones off. So yeah, sometimes it's contentious. Sometimes there are shareholders that say, no, not now. This is up and to the right. I don't want to go. But yeah, often it's, am I going to turn down a payday?
Sure. Okay. Which is a hard thing to do for any of us. Okay. And then my final point on our final topic, the one person who cannot be forgotten in any of these proceedings is the tax man.
He won't let you forget him.
He won't. So tax implications, you need to consider how the transaction is taxed, both for the company and for the selling shareholder. So it can be treated like capital gains. Sometimes it can be seen as a dividend. You need to check your regulations to avoid a nasty tax surprise.
Well, you want it to be treated as capital gains.
Okay.
That would be this is not financial advice, but that under current UK law would be, or UK policy would be more advantageous.
Okay. Sure. Even with the capital gains hike that we've seen recently, it would still be a better option than as a dividend. Just about.
Although I'm sure Ms. Reeves, Rachel from Customer Services, is keen to bring parity at some point soon. Because she's chasing this elusive cost of capital, and every time she speaks, the nation's debt becomes less affordable. So I'm sure she'll pull that one out of her bag at some point.
Well, how's that for a circular conversation? We started on a gripe about the Labour government, and we've ended on a gripe about the Labour government.
You can rely on me.
Excellent. Okay. Well, I think we're going to wrap that up there, but I think it would be a good time, Gareth, for you to talk once again about our acquisition incubator.
Oh, yes. Well, we've been rather spoilt by applications for the 6 coveted spaces that we've got on the acquisition incubator. Applications are still open. We have probably about 3x more applications than there are spaces available, but we must ensure that we are being super diligent and looking at all options available. So we'd love to invite any remaining applicants to apply before close of business on Friday, the 4th of April. And then we'll be communicating out in the sort of 10 days following that what we're going to do in terms of interviews and when the kickoff date is. But we would very much like any budding ambitious acquisition entrepreneurs that want that step up into the world of ETA to consider applying to acquisition-incubator.com.
Yes, I will put the link in the description of the video. Please do apply if this applies to you. And if you know anybody else in your network who would be good at this, you know who this is perfect for. If we're talking about this and you go, oh, I know such and such would be the great person for this, share it with them. Get the link over to them, get those applications in, and we will pick from the best of the best, the cream of the crop.
Yeah, absolutely. Looking forward to being able to share the names of the initial cohort participants towards the end of April.
Exciting stuff. Okay, so we're going to hand over to our community now for some questions. And for everyone else, Gareth, you want to sign us off with the immortal line?
Oh, our catchphrase, keep on crunching, folks.
Keep on crunching, guys. We'll speak to you soon.